You could not buy gold in the USSR or Mao's China during the last great gold rush of the bull market of the 70s, which, by the way, with the exception of cryptocurrencies, was the largest bull market there had ever been. People don't realize how big the 70s bull market in precious metals was. By the way, when I say that gold went up 25 times and silver went up 41 times, I'm taking the intraday highs and lows, so that is the maximum potential gains. But still, that is absolutely enormous. And until cryptocurrencies came along, that was the greatest bull market of all time. Now, cryptocurrencies, some of them will do well, maybe all of them in what's coming, but there has just been a lot of suspicion cast on them with the FTX scandal and other things that have happened in that sector. I do own some cryptocurrencies, but the largest portion of my net worth that's in a single area is physical gold and silver.
According to Mike Maloney, if gold went up 25 times and silver 41 times back in the 1970s, and then you consider the amount of gold available above ground today, it's roughly twice as many ounces as back then. Plus, there are 18 times more people worldwide who can access precious metals, and there's 55 times more currency circulating, according to the OECD. He believes something big is on the horizon. Even people like Warren Buffett, who famously called gold a pet rock, are unlikely to turn to Bitcoin. When those with the most capital people in their 60s, 70s, 80s, and 90s look for a safe haven, it probably won't be cryptocurrencies. Mike often points out that when we used gold as money, it was real money compared to today's national fiat currencies. Nowadays, no nation uses what he considers real money. He emphasizes the importance of distinguishing between money and currency. Money makes, currency takes. Money, he argues, is what propels mankind forward because it's honest and fair. In contrast, he views currency as dishonest, calling it fraud and theft. When you think about how currency is created, it's clear that when we used gold, the time and effort required to prospect, stake a claim, develop it into a mine, extract the ore, refine it, melt it down, pour it into bars, and finally mint those bars into coins, matched the effort you needed to put in to earn enough real money to buy a house. In his view, this work was equal to the effort needed to build that house.
It was a fair trade of something for something. When you use fiat currency, it's conjured into existence by a bank when you're buying a house. You take a piece of collateral. You find a home that you want to buy. This is my collateral. I want to borrow $1 million. The bank looks at your financial record and determines whether or not you're a good risk that if you can pay this loan back. And when they say yes, they imagine $1 million worth of bank credit currency, which is reminders that it's not actual dollars in your account, at least according to the Bank of England. It's reminders that they owe you a certain number of IOUs. But national currencies steal part of your future lifetime. This is my big point. It's a tool for enslavement. Just to have them around requires your future work hours to pay on the assets that were acquired to create these IOUs. The entire currency system comes down to it's nothing but IOUs. And what is it that they owe us? They owe us part of our own future lifetimes. We have been monetized. It's an IOU, YOU, IOUU. That is what they've done to the dollar. They've stolen more than 97% of the purchasing power of the dollar. And we are about to see gold make up for, it's lagging right now as far as it accounting for the expansion of the currency supply. And that is about to change. I think over the next 3 years or so, you're going to see some dramatic shifts. There's two things that are going to trigger this. The creation of currency during the pandemic, they increased the M2 currency supply by roughly 40%. Then they decide, oh, there's inflation, and they're like surprised. They wonder where that came from. And so to try and get a hold of inflation, they're going to raise interest rates and make them positive, but they're raising them at the fastest rate in history. There's never been anything like this. When you're coming off of such a low interest rate of 0.25%, And so, you go on the Fed's website and you can generate charts, and you go year over year percentage change, and it's like 8,000% increase. It's just totally insane, since they started the rate hikes. That has never been done before, and it will end up breaking something sometime or another.
When the 2008 global financial crisis hit, Alan Greenspan didn't see it coming. Greenspan had lowered interest rates to 1% after the Nasdaq crash, trying to reflate the stock markets. But in doing so, he inadvertently created a real estate bubble. That bubble was a side effect of those low interest rates and the rise of mortgage-backed securities. Mike notes that there wasn't enough oversight at the time, not that he's a fan of overregulation, but there needed to be more vigilance against conflicts of interest, which were rampant in the banking sector back then. The repeal of Glass-Steagall, Greenspan's rate cuts, and his failure to recognize the bubble he was creating all played a role in causing the global financial crisis. Now, Mike warns, look at what we're doing this time. We've never raised rates at such a rapid pace before, and the amount of currency that was created just before these rate hikes is astronomical. On top of that, the national debt rolls over roughly every 5 years, maybe a bit longer now, but essentially, we're talking about $31 trillion worth of debt that needs to be refinanced every 5 years. He points out that we're less than a year into these higher interest rates, so the real financial pain hasn't hit the budget yet. But after 5 years, all of this debt will have to be serviced at those higher rates. Mike sees this as a death trap. In any society, there are only so many goods and services available at any given time, things you can buy and pay people for. The currency supply is what facilitates the transfer of this real wealth, the goods and services from one person to another over time and space. If you inflate the currency supply, if you double it, but you don't double the amount of goods and services available, each unit of currency will have less purchasing power. Now, with twice as many units of currency chasing the same amount of goods and services, it's becoming a nightmare for people to make ends meet.